Alright, you ready for this? Let's make some magic happen here. Video prompt: US economy Q4 2025 and 2030 debt outlook. Estimated runtime 10-15 minutes. Welcome back to our global finance briefing. Today we'll take a deep dive into the US economy as it closes out 2025, and we'll look ahead to 2030 to evaluate America's debt trajectory and its ability to meet future obligations. This is more than just numbers on a page. It's a story about power, resilience, and the critical choices shaping the world's largest economy. So grab your coffee and let's take a closer look at what's really happening beneath the surface. To understand the US, we have to zoom out first. Global growth is stabilizing around 3% according to the IMF, while Europe and Asia are feeling the ripple effects of slower trade, supply chain restructuring, and geopolitical tensions. Emerging markets are showing resilience, but the gravitational pull of US monetary policy is undeniable. The Federal Reserve's decisions, the dollar's strength, and Washington's fiscal strategy all reverberate globally. Whether you're in Tokyo, Berlin, or São Paulo, the US economy still sets the tone for global capital flows. Now let's zoom into America. Growth has cooled to around 1.5%, a sharp contrast to the post-pandemic rebound. Consumer spending is slowing, and confidence has taken a hit, with households feeling the weight of higher borrowing costs and inflation fatigue. Job growth is also tapering, and unemployment is expected to hover near 4.8% early next year. The Federal Reserve has entered a delicate phase, keeping rates elevated to contain inflation while cautiously preparing for cuts in 2026. This balancing act signals one thing: the era of ultra-cheap money is behind us, and the US economy is recalibrating to a more disciplined environment. Washington's renewed tariff policies have introduced friction in global supply chains, creating pockets of uncertainty for investors and businesses. Some tariffs are even facing legal scrutiny, adding layers of unpredictability to an already fragile market environment. Investors are responding. The bond market is flashing warning signs. 30-year Treasury yields are climbing, reflecting higher risk premiums and growing concerns about US fiscal health. Gold has surged past $3,400 an ounce, and foreign buyers are increasingly cautious about long-term treasuries. This is not a crisis, but it is a wake-up call. As of late 2025, US federal debt has crossed $37 trillion, roughly matching the size of the entire US economy. The debt-to-GDP ratio is projected to reach 116% by 2034, and some forecasts place it even higher, near 125%. Debt in itself isn't new for the United States, but what's alarming is the rising cost of servicing that debt. In 2025 alone, interest payments are nearing $1 trillion, and by 2035, they're projected to exceed $1.8 trillion annually, accounting for more than one-fifth of federal spending. That's more than America spends on its entire defense budget today. In other words, borrowing is becoming more expensive, and that cost is crowding out future investment in innovation, infrastructure, and even social safety nets. Economists like Ray Dalio describe America's debt challenge as a cardiac condition. Without intervention, the system could face a slow-motion crisis. The US credit rating has already been downgraded this year, not because of an immediate inability to pay, but because of political dysfunction and a lack of long-term fiscal strategy. Geopolitically, rivals are watching closely. With a rising China, a fracturing Europe, and a shift toward de-dollarization, America's debt trajectory isn't just a domestic concern. It's a question of whether the US can maintain global financial leadership in the next decade. Despite these warnings, let's not underestimate America's strengths. The US dollar remains the world's reserve currency. Its capital markets are the deepest and most liquid globally, and its innovation economy continues to lead in technology and energy. What's needed is a reset. Fiscal discipline to control entitlement spending and reduce budget deficits, tax reform to stabilize revenues while encouraging investment, and debt restructuring strategies that ensure borrowing supports long-term growth. If Washington can muster political will, the US has the tools to manage this challenge. History shows America often acts late but decisively. So where are we heading by 2030? Here's a realistic forecast. Debt will remain high, likely between 120 and 125% of GDP. Interest costs will consume an even larger slice of the federal budget. Political polarization will complicate fiscal reforms. But there's also opportunity. AI-driven productivity growth, clean energy investments, and reshoring of supply chains could ignite a new economic cycle. America won't default. But the true cost of debt is flexibility. It limits how quickly the US can respond to future crises. We stand at a pivotal moment. The next 5 years will determine whether America remains the bedrock of global finance or becomes a cautionary tale of unchecked borrowing. For global investors, this means diversification, vigilance, and a keen eye on Washington. For policymakers, it's time to turn bold debates into bold action. America has faced bigger storms before. With leadership and reform, it can turn this challenge into its next era of growth. The clock is ticking, but history is still being written. Thanks for joining us today. If you found this insightful, give us a thumbs up and subscribe for more in-depth global analysis. And if you're a subscriber, do us a favor and leave a comment below. We love reading your thoughts. Stay curious, stay tuned.